This is a topic important not only to grade 12s but also for any South African taxpayer. Let's let the real me explain further.
Hi, welcome. In this series, we are going to be covering personal income tax. We are going to cover quite a lot. These videos are important for maths literacy students grade 12, but they are also important for anybody living within the borders of South Africa because the exact type of calculations that we do in maths literacy, grade 12 especially for this topic, are derived from the SARS website and what SARS says we should be doing in calculating our personal income tax. So what we are learning here is very practical and directly correlates to what is being done in the real world. So some people are hiring accountants to do exactly what we are going to learn how to do. That would save you as an individual quite a lot of money. If you can calculate your own tax, that's a huge saving. However, it will be important for you to calculate it accurately to avoid problems with the tax man or SARS later on in life. So let's go ahead and just talk about what's going to be happening in this series. We are going to learn about what is personal income tax. We are going to get a definition, and then we are going to look at a difference between gross income and taxable income. There's a huge difference between what we call gross income, what you get throughout the year, and what you are actually supposed to be paying tax on. Then we are also going to look at a definition on tax deductibles and classify the tax deductibles and just highlight especially the issue on donations because it can get confusing for some people. They think they avoided tax and then the taxman comes and say, hey, sorry Baba, your donation was not approved. You did not donate to people who qualify for you to get a tax deduction. And later on, we are then going to look at the actual calculation. How do you calculate an individual's taxation for the year, which is the amount that should be going towards SARS. So this is an important series. We will start it from scratch with the definitions. We will also later get some key terms that we require to learn and understand tax. What is personal income tax? So personal income tax is a direct type of tax that is levied on an individual's total annual taxable income. We will discuss this in detail. What do we mean by annual and taxable income? And it is payable to SARS. So this is money that belongs to SARS, guys. Now let's look into the fact of what is SARS. SARS is South African Revenue Services. So this is an acronym that stands for South African Revenue Services. This is an entity that is responsible for collecting money on behalf of the South African government. So that's their job, to collect the government's money that you are holding and I am holding. And then what is important about taxation, or what is taxation used for? The money that is collected, where does it go to? Well, these funds go towards government spending. For example, paying social grants. We know we have a lot of them in South Africa. Building schools, hospital, everything that has to do with public facilities. Parks, public parks. We don't have many of those in some areas, but that should be a case of government funding. Closing the portals. So we have a lot of portals around South Africa. That money should be going towards closing those portals. And there's much more. Before we continue, let's just take a look at the SARS document or the SARS brackets that are recently published in the SARS website. So we have bracket 1, 2, we are looking at bracket number 3. There are other brackets below here, but we'll focus on this one just as an example of how to read. Then we have that in this bracket, it's meant for people earning 383,101 up until 530,200 per year. They belong to this bracket. Now, their taxation is calculated as follows. First, they have a fixed amount of 79,998. Additional to that, they must calculate 31% of their income above 383,100. So the additional money above that. So first they subtract this, then whatever remains, 31% of that added towards the taxation. Now, to understand the topic on taxation, we will need some key definitions and key terms that are used and that help us to know how to calculate what we are looking for. So the first term used is that of gross annual income for an individual. So when we talk about gross annual income, we are talking about the total amount of income received by an individual in the given tax year that we are looking at before the consideration of deductions. Now, it's very important to highlight here. When we talk about this total income, we are not just referring to salaries. and wages. We are also referring to any money that you might have received from ancestors. We are referring to any money that you might have got from your betting slips. We are referring to any money that you might have won from the lottery, or maybe a payout from the road accident fund, or whichever case it may be. Whatever money you received throughout that year is going to be considered in your gross annual income. Whether you pay income on it or not, we will talk about the tax deductibles. But please understand, that is why most people get into trouble with SARS. They forget to include some very important cash receipts in their tax returns. Now, additional to that, we are going to look at tax deductibles. Tax deductibles, we are referring to amounts that SARS does not charge tax on. There are various reasons for this, but if you can remember what I said you must highlight in the previous section, it is important to note that SARS does not charge money or tax on money that is deducted for unemployment insurance fund. Now, why is that? The unemployment insurance fund puts away money for a working individual, for in the case that they lose their job, they will be able to receive money directly from this fund instead of getting a social grant. So this money is going towards saving the government money later that would be spent from the social grants. Rather put away the money from those individuals, then those individuals get their money back. And additional to that, of course, when they lose their jobs, or in the case of losing their jobs, hopefully until they are able to get back on their feet so that they do not need a social grant. Next, pension fund. Now, pension fund is also not charged tax. Therefore, we remove pension fund before calculating taxation for an individual. Now, let's look at the reasons behind that. The reasons is that we're going to tax that money later, when the individual finally gets their pension fund payout. So there's no need to tax them now because they never received the money to use. They were putting away the money to get a pension fund, and later when they really get the money into their accounts, the tax will come in. Next, we have donations, but be careful, please. With regards to donations, it must be stated, or it must be donations that have been approved as tax deductible. Some donations do not qualify. Donating to your neighbor does not qualify because your neighbor is not a registered charity or NPO with the government, nor are they approved to be doing any type of charity work. But now, why is it important for these organizations that qualify to be registered or to be doing charity work? When people do charity, whether it be helping the needy, building a road where there's no road, they are actually saving money that the government would have been using towards that. So the issue of other places, we know some companies like to build these classrooms for individuals and then they plug their name onto it. I know a bread company that loves doing that. I know other companies that do that, where they just build a classroom for a school, public schools that is, and then they plug their name for advertising, free advertising. But the main reason is the funds used to build that classroom will be tax deductible because they are giving it to a government institute, which is of course registered, and therefore will qualify for tax deductions under the donations part. All right, so now let's look into some more terminologies and more information that we need. Now we are going to cover the steps that are required for an individual's taxation for the year to be calculated. Now, firstly, we must look at the individual's gross income. So we're going to do the calculation for the individual's gross income by looking at if they do have a salary, plus their bonuses, any gifts that they have received, and every other thing we discussed, whether it's a pension fund payout, whether it be that they finally getting their insurance payout or their pension fund payout, it will all be added as the total they've received for that year for gross income. Then step 2, we are going to look at what is their taxable income, and this is the formula for looking at taxable income. We look at their annual gross income that we calculated in step 1, and then we minus the tax deductibles. So we did mention what are tax deductibles, that it be your UIF contributions, pension fund contributions, or approved donations, as we had mentioned. There are others, but we are only focused on this for the purpose of grade 12 learning. Then step 3, once we've determined the annual taxable income, we will then go into finding the individual's tax bracket. So given that amount, from what we saw from the SARS document, we can then see that since this is the individual's taxable income, which bracket do they belong to? because that bracket is going to show us how can we then calculate their tax assessed. There will be a fixed amount for most that they need to pay, and then there's another additional amount that we will deal with in the calculations practice. Then finally, tax assessed is not the money that goes to SARS. There is going to be a further calculation which we call calculating tax payable. So to calculate the tax payable, you take the tax assessed amount, you minus what we call tax rebates, we are going to look into those ones, and then you minus what we call tax credits. So after this step, only then do you find your annual taxation that needs to be paid to SARS. Then we can do a further calculation. Should we need to know what the individual should contribute monthly, because that's usually how the pay slips show, then we can divide by 12, get exactly how much monthly taxation contributions that particular individual is going to be looking at. So now, before we go through a lot of exercises or past papers, we also need to discuss a bit on what are tax rebates as well as the tax credits. What are those exactly, and which ones are we going to be focused on? Okay, now let's discuss what are these tax rebates. Now, tax rebates are a form of tax relief. So it's money that is reduced of the tax that is actually assessed and the individual is supposed to be paying. So it's a form of tax relief that SARS gives to individuals to make them pay much lesser money than they should be under tax assessment. And these amounts are based on the age of the individual. So the older you get, the more money or the more rebate you get. Please be careful of that, because we have two types of documents that are listing the rebates. Some of them, they just list the amounts that are additional to each age group. Others, they put exactly how much rebate that group should be getting. So if you look at the core idea that the older a person is, they've been paying tax for so many years, therefore they should get more incentive. So older people, there's no way that they can get lesser rebate money. So then if you see a table that shows that primary rebate is a larger amount compared to secondary, compared to tertiary, you should know that you are responsible for doing the addition yourself. That is, you have the primary rebate for individuals below 65. To get the secondary rebate, which is type 2, which is for individuals between 65 years old and 75 years old. So secondary rebate is actually the primary plus the additional amount given. Then tertiary rebate, which is for individuals older than 75 years, is going to be whatever you got for the secondary, add the additional or the more, then you will be able to get tertiary rebate. So the point is this: if you see a table then having the primary less than secondary less than tertiary, that's telling you they've already done the totaling, so you can take those amounts as they are. So this is just taught to us so that we can be able to differentiate and just pay attention to detail. Remember, some of the things we are learning in school are there to teach us to pay attention to detail, because number one, the text documents or brackets, they change every year. When the budget speech is given in February, they change around the numbers that are there. Therefore, we will be working with new taxation brackets, figures for the rebate threshold issues. Therefore, it's important for us to be trained in the different documents that we can receive and know how to handle them or to figure out the information that is necessary. So that is how we calculate tax. Now we can go to actual examples. And then later on, we will also deal with how to find what we call tax thresholds. Now that is the one that tells us that which individuals are not supposed to be paying tax. So how does a person know that they do not qualify for tax? Therefore, they will not be risking getting in trouble with SARS by not filing any tax returns. We'll look into that shortly.